Welcome back, ladies and gentlemen. While the previous panel discussion shed light on how rich investors make wise investments, it is imperative to know from the portfolio managers as to where will wealth be created going forward and what is the art of picking such right businesses. The topic of the next panel discussion covers this aspect, identifying the DNA of multi-bagger businesses of this decade. And the panelists are Mr. Dheeraj Sachdev, Mr. Samit Vartak, and Mr. Siddharth Bhaiya. Ladies and gentlemen, this session is going to be moderated by our very own Mr. Kamal Manocha. Let me now take a moment to introduce our panelists. Mr. Dheeraj Sachdev is the managing partner and CIO at Roha Asset Managers LLP, ranked among India's best fund managers by Outlook Business and Value Research in 2017. He was a senior fund manager at HSBC Global Asset Management, and prior equity fund management experience includes ASK investments in HDFC Bank. He's a leader who leads by example, and his 23 years long industry experience saw glory when he delivered long-term performance of 29% CAGR for 6 years for HSBC Mid and Small Cap Fund. And he holds a degree in commerce from Mumbai University, which was a BCom. And he's a qualified chartered accountant from ICAI and a cost and management accountant from ICMAI Institute, along with diploma in foreign trade management from Mumbai University. Currently, he manages AIF and PMS funds at Roha Asset Managers with a strong track record. A very warm welcome to you, Mr. Sachdev. Now, we have with us Mr. Samit Vartak, who is the founding partner and CIO at Sage One Investment Managers. He's a CFA charter holder, has worked closely with various companies in the US and India, advising them on business strategy, profit optimization, growth, and valuation. And he returned to India in 2006 after spending a decade in the US, working initially in corporate strategy with Gap Incorporated and PwC Consulting, and then Deloitte and Ernst & Young advising companies on business valuations as well as M&A. A very warm welcome to you, Mr. Vartak. Now, ladies and gentlemen, we have with us Mr. Siddharth Bhaiya, who is the Managing Director at Equitas Investment Consulting Private Limited. He's a qualified chartered accountant at the driving force behind Equitas Investment and has around 20 years of experience into equity research and equity fund management. Now, with his multi-bagger and contrarian stock picking approach, Equitas has delivered 32% CAGR returns over the last 9 years. He has been instrumental in taking Equitas from a startup to a 20 billion INR AUM with one of the best performance track record in the industry. And Mr. Siddhartha believes, in fact, he believes that generating outside returns are important by investing in small cap undiscovered companies. Mr. Siddhartha also started his career as a research analyst with Sushil Finance and has worked with StratCap Securities, Principal PNB AMC, and Reliance Capital Asset Management. Mr. Siddharth Bhaiya, once again, a very warm welcome to you, sir.
Thank you. Thanks a lot.
And now, ladies and gentlemen, towards our moderator, Mr. Kamal Manocha. He's the founder and CEO of PMS AIF World India. And as we all know, PMS AIF World India is a trusted investment platform for high net worth investors to make well-informed investments in PMS and AIF investment products. He's an honors in economics from the Hansraj College, Delhi University, and MBA in finance from LBSIM, and carries more than a dozen investment certifications and holds vast experience of almost 2 decades in the field investments. He's an enthusiastic teammate with the aim and purpose of serving clients with the most knowledgeable approach to investing. A very warm welcome to you again, sir. And now the proceedings are over to you, Mr. Manocha. Take it away.
Thank you so much, Aishwarya. Welcome, everyone.
Hi.
Yeah, hi. It has been, it is my pleasure and I'm delighted to actually moderate this panel. I have had opportunities of talking with Samit Vartak, I think, multiple times in the past. It was my fortune. And this time, we have all the 3 czars who are well known for discovering the multi-baggers, so to call. So that is why, the discussion is going to be very interesting. And before we start out here for our panelists, I would just like to state one, important point, because I'm going to correlate that to the overall discussion, that out here, as per my understanding, based on my, 2 decades of experience, and there are 3 types of investors, and all these 3 types of investors are today watching us. I am saying in the context of multi-baggers. The first type of investors are those who talk about multi-baggers, but who don't believe in multi-baggers because they believe that, multi-baggers only exist in the hindsight. it's not possible to predict, which company is going to become multi-baggers, and they are the ones who will invest maybe in multi-caps and maybe end up making around 14 to 18% kind of returns. And maybe they will be investing more in steady compounders or consistent compounders. The second type of investors are those who are excited about multi-baggers, but because the space of multi-baggers, or you call it penny stocks, is very wide and the information out there is less and knowledge out there is also less, and hence the experiences are mixed, because they end up owning maybe 40% good companies and 60% are not good companies, and then they sell good companies early and hold on to their bad companies, and hence their returns are even lower than the first type of investors. But the third type of investors are entrepreneurial, and they are the ones who actually make money in so-called multi-baggers, because they invest around 80% of their portfolio entrepreneurially into multi-baggers and actually multiply their wealth, at a magical rate of say 25, 26% and make 10 times in 10 years. So now, my first question to Samit, in context of first type of investors who actually do not believe in multi-baggers, who kind of, believe in steady compounders, what are your thoughts, that are there any traits which are actually available for us to identify multi-baggers, or you as a portfolio manager also get to know about a multi-bagger later, once it becomes a 10 bagger or a 50 bagger in your portfolio? Over to you, Samit.
Sure. Yes. So Kamal, I think what you said is exactly right. I believe in that at the start, a lot of times you are not sure whether it will be a multi-bagger. And that's the only reason you have a, well diversified portfolio. I mean, if you were so sure, you would probably just invest in one or two companies, right? So we don't know which one is going to be a multi-bagger. Typically if you pick, 20 stocks, out of them maybe 20%, if they happen to be multi-baggers, you are going to be lucky and they will deliver you the kind of returns that you're looking for. Right? Question, I mean, see, everyone has a different strategy. So, Siddharth would have his own strategy, Dheeraj would have his own strategy, I would have a different strategy. And each of those strategies can create multi-baggers, right? For me, multi-bagger meaning that anything which doubles in 3 years, is a multi-bagger, which meaning that you're looking for 25% plus returns. And 25% return, even if I just hold it for 1 year, I count that as a multi-bagger. It's a relay race. You don't have to hold the entire stock for 10 years or 15 years. And when you're looking for large multi-baggers, they happen within the matter of 2, 3, 4 years. And later on, then they come down to a more reasonable growth that typically a market goes through. So for us, multi-baggers, the only way you can create multi-baggers if you find companies which are growing at 25% plus kind of a growth rate. And for that 25% in the long run is not that easy. I mean, it is extremely rare for a set of 20, 25 companies to keep you delivering this 25% kind of a rate. And hence, it's a relay race where portfolio that you hold today will be different than what you hold maybe 5, 6 years down the line. And there are common traits, depending on your strategy, there are common traits where a 25% kind of earnings growth is possible. One common trait that I've found, one is it needs to be one of the most dominant company in the industry, because dominant companies are some of the most resilient. The difference between that company and the rest of the competition, I think, is one of the most important. If you have that, then even if you have a bad environment, typically, a lot of weak companies may not survive and they end up taking away market share. So dominance is one, and dominance doesn't mean that you have a high moat and, very difficult to, entrench into that mode. The one of the factors that I look for is market share gain. If you're so dominant, then you should be able to take away market share from. So that is one of the biggest trade, because most of the industries will grow at that 12, 13, 14% kind of a rate. You're looking for double of that rate, and it can only generally come through either you're able to take away market share from others, or secondly you have such a great execution strategy that you get into newer categories of products which are related, where there is synergies, where you have the expertise. And that is another way of gaining higher growth than what you look for. So I mean, those are the common traits. It's easier said than done. You can easily say, but see, just looking at history doesn't mean it's going to happen in the future. Analyzing history, any computer can do. right? It's all about, do you understand the strategy? Do you understand the positioning of that company against the competition? Once you understand that industry, it's easier to understand whether that company will be able to sustain the growth that it has probably done in the past, or whether they can do even better than that. And another part of multi-bag return is that how do you eliminate or how do you reduce the risk of you getting into something which turns out to be an average company or a weak company? Because in a 3-4 year kind of when you enter into small cap, mid caps, and you're looking at just small time frame, and small I mean just one business cycle which may last for 6-7 years itself is a small time frame. And in that kind of a time frame, you will not know whether it's a quality business or not, because just because it went through a really great 5-6 years doesn't mean it's going to do that same thing for the next 5-10 or even beyond that. So that is extremely important. There is no alternative to understanding the business as in depth as possible. That is the secret of multi-bagger. Once you have the right framework, once you know what exactly you are looking for, that's important. But how do you execute it? What are the kind of studies that you do? How do you do your groundwork? How many people do you talk to? Just to understand, get perspective, not just from the management, but also to get from the competition. That is what will deliver you, those kind of multi-baggers. And it's all about, for us, like, in the last 10 years, when you look at our investments, we have done investments across the two portfolios in 80 companies. And out of the 80 companies, more than 50 companies have delivered more than 25% annual returns. So that shows the breadth of returns. It's not concentrated just because of 5-10% of the companies. Almost 2/3 of the companies have delivered more than 25% CAGR, and only 12% have delivered negative returns. So it depends on your strategy. Some strategies can be a little high risk, high return kind of strategy, but based on our strategy, this is what we look for in a multi-bagger.
Sure. So Siddharth, my question to you for the second type of investors. And why, I am keeping it for second type of investors, the question for you, because my understanding is that though Samit is not too much, focused on the valuation, he will be focused more on maybe the earnings. As he said, he wants a company to be doubling its earnings in 3 years. But at the same time, your style is more towards identifying a company much earlier, when maybe, the company's valuation is much, much lower, and it is an ignored business. And that is exactly where a lot of investors go wrong. And that is where maybe, it is confusing to kind of distinguish between a penny stock or a potential multi-bagger. What are your ways to identify and kind of, how do you ensure that mistakes do not happen?
I think Kamal, the first thing that I want to say is I find it really difficult when people say that it's difficult to find multi-baggers in the stock market. The stock market itself has been a multi-bagger. Sensex started at 100 in 1979. Today it is 60,000. Right? It has gone up 600x. I started my career 20 years back. Since then, the Sensex has gone up 20x. So practically the money has doubled every single year. If you are in the markets to make 15-20% stocks returns out of individual stocks, on an average, you're not going to make 15 to 20% stocks, 15% return on your portfolio. So I think the key is how we visualize it. If you want to invest for 15 to 20% returns, you're going to get 15 to 20% returns. If you're out there, right, a Virat Kohli, when he goes to bat, he thinks of scoring a century. He doesn't think of scoring 50 runs because that's my test average. Every time he goes, he tries to score a double 100, and that's how his average comes down to 50. Right? Because there are times when you're going to get out for a duck. Coming back to penny stocks, clearly, I think Samit as well mentioned that if anything outside the top 50 stocks in the country is small cap, probably top 100 stocks is a small cap, right? And then that space is littered with a lot of, shady companies. So the first and foremost thing that we look for when we are investing in a company is it an industry leader, right? If it is, how do you define industry leadership? Either it should be the biggest in terms of revenues or market share in the country, or it should be the most efficient. Right? So it's like saying there are top 3 students. So that's very, very clear that, just because it is outside the top 100 doesn't mean that it is a good small cap. If you're going to go into penny stocks and kachra companies, definitely you're not going to have multi-baggers. Multi-baggers is about identifying high quality companies which are mispriced. So the first and foremost thing, so we have a three-pronged approach to identifying a multi-bagger. It's a function of valuation, it's a function of growth, and it's a function of contrarian approach, right? And it's the biggest myth that goes around is that to identify multi-baggers, you have to go into small caps. Hindalco has been a 5-bagger over the last 18 months. And it's a nifty stock, right? Larsen and Toubro from 2002 to 2007 went up 50x. And it was a nifty stock at the start of its journey and at the end of its journey. So one, definitely 100%, you don't have to go beyond. It does not need to find multi-baggers. You don't need to go into the dustbin. You identify good companies which are priced out of whack. So first and foremost, in investing, any investing, the whole objective is to buy assets at a discount to their intrinsic value. And in equities and in stock markets, you have to buy them at a significant discount to intrinsic value, because stock markets gyrate between 10% of intrinsic value to 500% of intrinsic value. Right? That's why you could get Hindalco at 0.1 times market cap to sales. And the same Hindalco in 2007 was available at 3 times market cap to sales, 4 times market cap to sales. So one, valuation is most important, according to me. When you buy value, and if you create a basket of stocks, it's very unlikely that you're going to lose money in the stock market. And as Buffett says, there are 3 rules to investing: never lose money, right? And rule number 2 and 3 are follow rule number 1. So if you buy value, you're not going to lose money. Second, growth. Growth is very, very important because the market pays a P multiple to growth. But historical growth is irrelevant. What has happened in the past is already discounted in the stock price. What matters is the future growth. And to a large extent, future, we really don't know, right? Walmart was the biggest company in the world, and then Amazon came. And it nearly disrupted Amazon, right? Vodafone was a nifty company. Bharti was a nifty company. And then we all know what happened after Jio came in. So what matters is future growth. And nobody could envisage the kind of damage that Jio would do to the telecom sector in the country. For the others, for the competitors, for the consumers, they have done really well. So future growth matters. And typically in my experience, what I've seen is at peak profitability, stocks get peak P multiples. And at bottom profitability, stocks get bottom P multiples. So when you're buying at low P multiples, you're probably also buying very low P multiples, or very low profitability margins as well. So, and third is contrarian. As I said, contrarian doesn't mean, you're going to be going against the crowd. You don't need to go and short Bajaj Finance just because you don't like it or for whatever reasons it's done well. You have to buy something which nobody else is buying, right? Everybody talks about ITC. Nobody talks about Hindalco. Nobody talked about Hindalco. Even Hindalco had equally poor returns. Right, till a year back, nobody was talking about Tata Steel. Nobody was talking about Larsen and Toubro. So I think a combination of these 3 things: you buy low P, if earnings growth comes in, it is under-owned, it's a contrarian stock, nobody's talking about it, there's no research. And then as it gains popularity at the peak, Twitter is full of research reports on that particular stock, and that's probably the time to exit. And I've seen it time and again.
Right. Well put. My third question is for Dheeraj. Dheeraj, your portfolio over last 1 year, if I talk about PMS or if I talk about AIF over last 3 years, has actually done the best returns. And this is despite, your portfolio being very well diversified. And this is one area which is different than maybe, the other 2 panelists that we have, because the other 2 panelists kind of believe more in creating a high conviction portfolio, and yours is a well diversified portfolio. So my question to you, from the context of third type of investors that I said, I'll just remind you that these are those type of investors who are entrepreneurial, who like to invest entrepreneurially in the field of multi-baggers, but they would invest 80% into kind of multi-baggers. At the same time, they will invest 20% into steady compounders. So what they prefer is to have maybe high conviction, a Sage 1 portfolio or an Equitas portfolio on one side, and at the same time put 20% into a steady compounders portfolio. So, what do you say to these investors with regards to your style? would such investors benefit by putting 100% into a well-diversified portfolio of kind of multi-baggers, or the way they are doing is right?
So, hi, Kamal. I think a large part is obviously covered by my fellow panelists, both Samit and Siddharth. But just to get the context rolling, I think multi-bagger stocks are not created overnight. It's very clear. Neither they can be predicted upfront. So it's very important to identify the character of such businesses and then hold on with conviction and patience to reap outsized or superior returns in such stocks. And typically, it's not about the 80-20 rule. What we need to spend time on, and we generally do it as far as our diversified portfolio is concerned, is to ensure that the character of such companies has the traits of being a multi-bagger over time. Like, for example, there are 4 or 5 very common traits that I would like to highlight. One is that the companies that are operating in a very large addressable market that gives scalability in business model to ensure consistent or sustainable sales and earnings growth over long periods of time. And that's a very important part in terms of power of compounding. The second is the companies need to have an enduring competitive advantage, whether cost, brand, client relationship, or R&D strength. The third is the company should have cash flow generating business model to fund future growth capital. I mean, they are not dependent on borrowed capital or debt capital to fund the growth plans, but they are generating enough operating cash flows to incur the capex for, and along with high returns on capital employed that reflects superior capital efficiency. And number 5 is promoter skin in the game in terms of ownership and management ethics in terms of right capital allocation. I mean, these are 4 or 5 traits which are very important at the beginning when we identify and buy companies in the portfolio. So broadly, consistent growth with cash flows and capital efficiency will ensure power of compounding to eventually reflect in the stock generating multi-bagger returns. Now, a large number of multi-bagger companies do come from a stage when they are small, unknown or unpopular, and partly it has been touched upon by Siddharth as well, and not when they are already popular, discovered, and discounted. So though a minority of companies that are discovered may grow in a compounded fashion and still generate multi-bagger returns, but in majority of cases, the identification or discovery has to be when they are small caps. Now, if we classify the multi-bagger sectors based on nature of business, it can be divided into, for example, the number 1, as you mentioned, compounding business with scalable and predictable character. I mean, these include the likes of traditional sectors like pharma, specialty chemicals, financials, and consumer. Incidentally, just an example, one space or sector that has given several multi-bagger stocks over the last decade or so is clearly specialty chemicals, and many of them have demonstrated common characters mentioned earlier. The second multi-bagger sector that we would like to identify can also come from cyclical businesses, which are volatile in nature, but many companies can still be multi-baggers provided one is in the early stage of life cycle of such commodity businesses. We saw that happening in metals and commodity chemical companies over the last 2-3 years, and several of these companies have gone 5 or 10x over the last 2-3 years. Currently, we believe engineering and capital goods is at the beginning or cusp of a long uptrend in manufacturing cycle, and many of them can qualify to create multi-bagger returns. They may be in the business of pumps, CNC machines, compressors, welding products, machine tools, automation, etc., to be part of entire manufacturing ecosystem. So to answer your point, even cyclical business, even if it is not predictable, if you're in the early stage of life cycle of those businesses, can create multi-bagger returns. And the third is the early stage of concept or new age businesses, the likes of EV, green energy, renewables, biologics, digital platform companies. Given the fact that there is a long runway to growth, including regulatory support, which is very, very durable. So select companies operating in the ecosystem are likely to create multi-baggers of this decade. So what is important is it's not the 80-20 rule. The balance can be whatever mix at a point of time, but we have to ensure that the basic hygiene or character of a business in terms of enduring competitive advantage, cash flow capability, large addressable market size, high returns on capital employed, and promoter skin in the game in terms of right capital allocation. These basic hygiene has to be present. Otherwise, you have to avoid or ignore the company.
Right, Dheeraj. Samit, my question to you now, I see that, you have a longest track record out here in terms of, managing a multi-bagger oriented portfolio. and over last more than 10 years, your returns have been upwards of 30%. But obviously, as we have been seeing, that last decade has shown a lot of learnings to a lot of businesses, and things have been kind of evolving. We have seen a lot of disruptions, and in line with that, I'm sure your own rule book to identify multi-baggers would have also evolved. What is it that you see today as a checklist to identify multi-baggers for the next decade, for the next 10 years? What are the modern or the new characteristics that that have come into your guide in that context?
Right. See, I mean, in terms of the main parameters that you look for in a multi-bagger, they haven't really changed, because the basic qualities remain the same. I think the sectors probably would change, because I mean, when you're looking for a multi-bagger, as I said, it's very difficult to take a 10-year view. Typically it's more like you take a 2 to 3 year view, and then keep on holding if your thesis is playing out, as well as it keeps on meeting your requirements at every point in time, right? So they turn out to be multi-bagger. Now if you look at 10 years back, my portfolio was probably dominated by a lot of consumer oriented stocks. I had also started investing in a lot of chemical companies, obviously PI Industries and Aarti Industries, those kind of companies. But I also had Page Industries, I had La Opala, I had Serra, those kind of companies. I had financials, right? So, and it wasn't that I thought that these are going to be multi-baggers 10 years down the line. It's just that there was momentum based on the study that we did. We got enough confidence that at least they will meet our criteria, that they should be able to grow its earning of by 25% plus over the next 2 to 3 years. And it's in hindsight, how your portfolio delivered. So even today, I mean, nothing really has changed. I would say overall, the environment in the last 10 years was extremely difficult for companies. Many of the companies have evolved. There were so I mean, compared to the last 10 years, I think the current environment for a lot of businesses with pretty robust demand, such low cost of capital, almost deleveraged balance sheet. Even the banking system is cleaned up. The government, is very supportive of corporate India. I mean, look at the tax cut they did, 30% to 22%, and for new manufacturing from 30% to 15%. Right. So, I mean, with these kind of helpful environment, Indian companies have become very competitive. And, I'm with, Dheeraj when he says that I think the next few years are going to be for companies who are going to be capex oriented, capital goods oriented, because that's the focus area for the government. And that's where, we have promoters who have gone through a really tough phase. They have become much more mature, and they have been very frugal. And you're almost doled out this huge tax cut plus the PLI scheme. So it's all about in the next few years it could be very different sectors. May not, there is no real change in what you look for in those companies. What you look for in 10 years back and today is exactly the same. It's just that when you analyze a business, there are certain things that you learn. Sometimes I think the biggest mistakes that we have made, those 12 stocks which have delivered negative returns, are mainly stocks where we thought it's a long-term structural growth story, and they turn out to be a completely commoditized business. So, but not always all the businesses will you be able to get it right, and that's where you have that 15-20 stocks, those 15-20 stocks in your portfolio. So you learn what tweaking you need to do when analyzing a business, but the basic parameters remain the same.
Right. So as a fund manager, Siddharth, this question is to you. Though Dheeraj and Samit, they believe that market economy is in a growth phase, and we are seeing a capex cycle, and hence obviously some of those companies will be the next leg of multi-baggers. But my question to you from investors' perspective is a little complicated one on the cycles of small and mid caps. And what do you believe in the context of identifying a multi-bagger oriented potential portfolio, how important is a conducive market environment? Because at the end of the day, price is the king, and we have seen last 2 years have seen massive rise in the markets. And we know that now, obviously, though the economic growth is visible, but at the same time, we have seen, there has been 2 years of rise, and generally it works in cycles. And ultimately, beyond a point, it sees a fall. So in that context, how do you want to address this part?
So I think, right, Kamal, the biggest thing that I noticed is, right, we spoke yesterday and you asked me what is the market capitalization that you look at. And my answer to you was, I don't look at market capitalization when I'm shortlisting company. It's the most stupidest metrics to shortlist a company, right? What you want to look at is revenues and profitability. I have seen large caps become penny stocks and then eventually delist. And I have bought stocks which are not even part of the small cap index, like Avanti Feeds, like Phenolics, like Galware Wall Ropes, like Nilkamal, like Apar, like HEG, and eventually they went on to become part of a group, and that is when we sold. So the whole point is, when the market capitalization became big, the funds wanted to buy it, the return ratios are fantastic. But at the bottom, so it's all about the future. It is all about cycles play. There are so many large caps which eventually delisted, right from Jet Airways to GVK to JMR to Lanco to Suzlon to all these companies. And they were all popular stocks. Every mutual fund in the country owned Jayaprakash Associates at one point in time, right? Paytm and Zomato and PB Fintech and whatnot were all large caps when they listed. So the whole point is, you have to look at a business and what is the relative price that you're paying for the business. Price is what you pay, value is what you get. And most people tend to forget that. So I really get annoyed when I get questions being asked on market capitalization. Market capitalization, if I'm telling you that you have a company which does a 500 crore profit and is available at 2,000 crore market cap, it might be a small cap, but if you look at the profitability, it would probably be amongst the top 100 companies in the country in terms of profitability. Right? So that is more important to me. The revenue is more important to me rather than the market cap.
Right, but at the same time, my subsequent question to you, Siddharth, is that the market cycle also, is it important in terms of, achieving the desired objective and result, or, there can be a healthy multi-bagger portfolio irrespective of non-supportive markets?
I'll tell you four investors in their personal capacity who I know, right? One is Buffett, obviously, and 3 are in the Indian context, which is Rakesh Jhunjhunwala, Radhakishan Damani, and the Inam Group. And I've looked at their holdings, and I started my career somewhere in 2001. And I can tell you they've been holding their stocks since those periods. They have not sold. Titan became Titan because Rakesh Jhunjhunwala bought it at 4P multiple and held it on for more than 22, 23 years. Right at that point in time, Titan wasn't what it was. He himself come and said, I bought it because it was available at 4P multiple. So all you need in your life is, and they have seen drawdowns of 50, 70, 90%, global financial crisis, 2001, right? The COVID pandemic, and they've held on to it. So the one thing that I've realized over so many years, Kamal, is if I would have bought every single stock over the last 20 years and not sold a single stock, I think I probably would have done better than what I did. So one thing that experience teaches you is that you hold on to your winners and you ride them over multiple cycles. A good company will eventually in the long run do well.
Sure. So Dheeraj, the next question to you is in terms of identifying, now if we say, as Samit said, CAPEX cycle, is one area from where we can pick multi-baggers as one story which is expected to play out very well. Apart from this or within this, if you could kind of name type of businesses or sectors which you feel investors should kind of focus upon in terms of identifying multi-baggers for next 5-7 years.
So Kamal, I think I would like to touch upon the themes in India that would drive several businesses or companies to be multi-baggers in this decade, because that's the topic of discussion as well. So one is in India's beginning of a manufacturing cycle, and clearly lower tax rates at 15% for new manufacturing units, PLI scheme, China plus one strategy of global players, levy of import duties are supporting India's manufacturing sector. I mean, new business registrations in the manufacturing sector are up almost twice or 2 times since 2019. and India's share of exports in global trade is rising. So both government policy and global supply chain factors have come together for a sustained upturn in India's manufacturing cycle. And I think this is going to be the theme over the next several years. The second is accelerating digitization, which we all know of thanks to COVID pandemic, which has accelerated the shift towards digitization. So e-commerce penetration is likely to grow multifold. So companies that are quick to be part of digital ecosystem or online distribution will do well. The third is, you have to understand that the green energy, whether renewables, EVs, gas, ethanol, is another durable or multi-year business theme. I mean, over the next decade, India's renewable would account for over 1/3 of total power generation mix versus 20% today. And annual spend on solar photovoltaic modules, PV modules, batteries, and wind turbines is set to grow meaningfully. Ethanol blending program, which is now at 8%, has a target of 20% over time. EVs are making headlines, and a hydrogen mission has been launched in 2021 with pilots underway. So select companies that are part of this green energy ecosystem qualify for providing multi-bagger returns. The fourth theme that I believe which is happening at a gradual pace over the last 15 years, and it is only on now accelerating, is a shift from unorganized to organized sector, which has been gradual but accelerating than before. There will be increase in consumption of discretionary categories like beauty and personal care, where current penetration levels are low. So there is growing preference for organized retailers or known brands in grocery, apparel, footwear, plywood, jewelry, packaged food consumption, etc. And several companies in this segment are well placed to benefit from this shift. And fifth, I believe, and we are all part of this ecosystem in the capital market area, is a very durable trend change in financialization of savings into investment products like equities and insurance as a preference for new gen or millennials versus gold/fixed deposits. And I think this trend will only accelerate going forward. So in a summary, I think India's beginning of a manufacturing cycle, accelerating digitization, green energy, shift from unorganized to organized sector, and financialization of savings are 5 themes where I believe a lot of money can be made in some of the companies which are part of this ecosystem.
Right. I think you have given more than what I expected in terms of themes. And Samit, my question to you now, when we see markets rise and everything rises, and as Dheeraj mentioned, there are so many themes. How, and we know that when stock price rises, one tends to get trapped. How to kind of differentiate between kind of I would say skill and luck, and how does this confusion as a fund manager when it comes in front of you, how do you kind of take yourself out of that and be patient and focus on kind of what is good and ignore maybe what is a trap?
Yes, last couple of years we have seen everything, and across the board, almost everything has done well. You just have to randomly pick, portfolio from maybe the small mid cap, and then it would have done well. So it's extremely difficult to differentiate between whether it was skill or the luck. And mostly in these kind of times, the higher risk you take, the higher the returns are. Right? Just look at an example like when after COVID, there were a lot of supply chain disruptions. There were shutdowns across the world, and suddenly the prices of certain chemicals, commodities, they rise, and so there is a huge inflation that we have seen in the recent past. And in the initial phase, generally, because you have gone through a slow phase, you are sitting on a huge inventory, and then the margins suddenly expand. And then the second phase is when even your inventory cost with raw material prices going up, they rise, and slowly the margins start contracting, and that's the phase probably where we are in today. And then there will be third phase, when the inflation rises too much, it will impact the volume, and most of the times the companies won't be able to pass on the such a huge inflation. And that's where I think the differentiation will start to happen. So when you look for companies, you need to make sure that the profitability increase, what exactly is the reason behind that profitability increase. You need to be sure about that. Otherwise, it's easy to confuse a lot of these companies where there could be phenomenal earnings growth, there could be phenomenal profit growth. The ROE, ROCE will look, a lot of parameters will start meeting what you are looking for, and it may qualify as quality companies. And there are stories which get circulated around it, and the stories are so convincing that you will easily get trapped. So in such environment, rather than trying to fall for the stories, and you get into that FOMO kind of a mode where that, okay, this is a story, this is going to be caught up by the markets, and then the stocks start running up 20, 30, 40% in a matter of few days, and you tend to just fall for it because you don't want to miss out. So that is a trap that one has to be, because you have to be disciplined irrespective of the market cycle. And it's very easy to loosen your discipline in such environment. You have to see if the margins that they are generating, is it sustainable, or is it just because of pure luck, because of the disruptions that's been created, or the short-term huge demand jump which has been created. Almost all the companies do get the pricing power, but when this sort of wave gets down, many of the companies, you realize they don't have the pricing power. I mean, they just then the drop is as severe, and not only does the earnings go down, but also the P multiple suddenly gets derated. And it's doesn't get derated by 15-20%. It can get derated by 60-70-80%. And that's a trap which is easy to get into in such times, because there are so many successes. You get confident, and in the recent past you have done so well by investing into these kind of stories, and you keep on falling for them. So this is the time where you need to have the highest discipline getting into any company.
Sure. Siddharth, do you agree with Dheeraj and Samit on their respective views? And also, this is the last question to you. We have 5 minutes to wrap this up. I would like to understand from you, because, I see that over 9 years, your performance have also been extremely well. And because you're operating in a kind of a micro cap and a small cap category, where I feel it is very difficult to get information and very difficult to get, data. And what is your secret sauce that you apply, and how does one apply that secret sauce today at these high valuations?
I think first and foremost, we have a great team. Second, we don't look to, we do our entire research in-house. We don't talk to anyone. So if we go right, we take the credit. If it goes wrong, we know whom to blame, which is ourselves. I think if we talk about, information not being available in today's day and age, right? Everything is available. When I started my career, companies didn't do analyst meets and con calls, forget having an IR department. And today, every single company has an IR department. Every company does con calls, they put out press releases. Data is much more available. Thanks to Geo, internet is a lot more this. You need to know what you need to look for, right? So I think let's not complicate investing. People love to complicate investing. It is simple: buy cheap, buy low, sell high, which is one of the most difficult things to do.
Right. Thank you, everyone. I think, it has been a pleasure interacting with you.
Thank you. Thanks.
We have had our, learnings. Absolutely, equity market provides these learnings practically when one dabbles with the discovery of, so-called multi-baggers. And so out here, we had these 3 fund managers who have actually built their careers over last decade, giving multi-bagger kind of returns to their investors. Thank you, everyone.
Thank you all.
Thanks, guys.